Good morning, it's Jeffrey Christian from CPM Group. It's 9:50 in the morning on July 5th. Golden struggling to get on, stay on either side of $1,800. It's looking kind of vulnerable. So is silver. Platinum and palladium are off sharply. The markets are relatively tight. I want to talk about hedging prices today. And I have some old slides really from 2016, January of 2016, but they're still relevant. Just to talk about hedging prices. And the slides I have are aimed at producers because that was the target that I was working with at the time that I did that. But the same concepts work for our investors. And the investors that we know who have been most successful have often hedged their investments. And I will show you ways that you can hedge and ways that we like our clients to hedge that we find to be most efficient. And in fact, the World Bank in the 1990s studied commodity price risk management and said CPM Group has what's probably the most efficient commodity price risk management strategy that exists today. That was true in the 1990s, and it's still true today. So I want to run through that. And then at the end, I'll talk a little bit about silver prices and what real silver prices are, given some of the current banter going around in the market with the lower prices. But let's talk about hedging. If you are a producer and you sell on the spot market, you're fully exposed to rising and falling prices. And this is gold prices from January of 2016. Gold price rises, you make money, more money. Gold price falls, you lose more money. And that's very important to know because hedging is a difficult subject. And a lot of mining companies, financial and treasury operations will avoid hedging because if the price falls and our company goes out of business, it's the market's fault. If the price falls or if I've hedged and something goes wrong, it's my fault and I lose my job. So there is a tendency among a lot of financial managers in the mining industry to not hedge because of personal career risks, which is sad because they actually have a fiduciary responsibility to their shareholders and other stakeholders, including their employees, to try to manage their price exposure in such a way as to keep the company going. The first rule of business is to stay in business. Now, the same is true with investors. You can have metal and you can stay fully exposed, or you can protect yourself from adverse price developments while maintaining exposure to beneficial price developments. And I've explained this in past videos, but it's important and worthwhile, I think, to renew and review over and over again. And we've had several entities approach us saying, we would love to have a training seminar on hedging strategies that CPM Group could do, record, and then sell those recordings to people. And we have been very slow in trying to figure out how exactly to execute that. But we are continuing to think about it and talk about it. Now, if you don't want to be fully exposed to falling prices of your commodity, whether you're an investor or a producer, you can sell forward. But when you sell forward, you're giving up all of your exposure to beneficial price developments, rising prices in the case of a producer or an investor, while you're taking out your exposure to adverse price developments, falling prices if you're a producer or a consumer investor. So what you do is you buy a put. That gives you a floor price, and it gives you exposure to the price rising because a put gives you the right but not the obligation to sell at a given price. So if the price rises, you still have your commodity if you're an investor, and the price is higher, and you've paid that cost of that put, so your return or your effective price is a little bit lower than the spot price. But if the price falls, you have the right to sell that commodity at that price. This is January 2016. We priced this for the 12 months of 2016, and you could, the price was around $1,080, I believe, at the time, and you could lock in about that price. And if the price fell to, say, $900, which it didn't, you could sell it $1,080 and buy back at $900. You'd still have your exposure, but you would have extracted $180 in profits, or $280 in profits. So that's that. But a lot of people don't like paying for puts. So what they do is they look for compound options. And banks and dealers like to sell collars. And in a collar, what you do, if you're a producer or an investor, is you get a little bit more price exposure. So here you can see the orange line is spot sales, the spot price of metals. And you buy, this is actually from oil in 1999. This is from a World Bank study that we were doing on commodity price risk across commodities. And we were using oil at about $15 a barrel. And you can lock in that minimum price. And then if the price rises, you get a little bit more. And that's what you earn. Let's see if we can do this. But you give up all that other blue sky that's in the orange here. So what we do is what we call participatory or compound options. And what you do is you reverse the field on banks. And when I met Jim Lewis from Wall Street Silver in May in Vancouver, and we had a nice long talk, he was asking me who CPM Group is and what we do. And I was explaining to him why it is that banks don't like us. And this is one of the main reasons why banks actually don't like us. Because what we do is we reverse the field on them for producers and for investors, and we give our clients most of the exposure. So let's see if we can do this. That's a participatory option. With a participatory option, the client, whether it's a producer or an investor, keeps most of the upside exposure and protects itself from falling prices and gives its counterpart, the hedging service provider, this sliver. So if you think back to that previous thing of the collar, there was a little sliver that the bank gave the producer or the investor. And what we do is we reverse the table on it, and we say, you get this little sliver, which is your transaction service fee plus this. And we give our clients most of the exposure to rising prices. It's a very simple, elegant thing. It's so simple and elegant that when we developed it in the mid-1980s, and then again when we tried to look into it in the 1990s, we found that we could not copyright it because it's so common and so plain. It's not suitable for copywriting or trademarking or patenting. And it's interesting because what you'll find is sometimes banks will actually offer this on their own, but usually you have to bring it to them. What you do with the participatory option, whether you're a producer or a consumer or an investor, is you lock in a minimum price, you protect yourself from lower prices. In the case of a producer, you can say, I have a minimum price guaranteed, which covers my costs of production, and I'm good going forward. You keep most of the exposure to rising prices. You have a predetermined maximum loss mark to market that you could earn. It's actually not a real loss because it's a loss mark to market. You're not actually losing that money. And it's a contingent premium or contingent liability that only kicks in if the price rises in your favor. And in terms of credit restrictions, you don't have to worry about having your credit tied up with margins and mark-to-market credit requirements because you have a predetermined maximum mark-to-market credit exposure. So it's a very elegant solution to hedging for producers and for investors. And given the volatility and uncertainty in the market, and given the extent to which so many investors are now expressing dissatisfaction, especially with silver, but also with gold, we thought it was a good time to bring this back out and talk about it in front of investors, but also in front of producers. This is a good time. You know, people ask us, when is a good time to hedge? And the answer is yes, always. It's good to hedge when the price is low, if you're doing it in such a way that you retain the upside exposure using a participatory structure. It's good to hedge when the price is high because the price might come down. And it's good to hedge when the price is in the middle. It's always good to hedge because what you can do is skew the poker table in your favor. I will lose X if the price does this, mark to market, but I can gain on an unlimited basis if the price moves in my favor. And we have a lot of people who have become disenchanted with silver and with gold and with commodities in general because they haven't done what they expected. You know, and this is a way to win even if you're wrong. So these are the prices as of last Friday. We saw the price come down. Silver fell below $20. It's struggling still. Gold fell to $1,800. It fell below $1,800 today, and it's trading below $1,800 as we speak. I wanted to talk a little bit about the prices, because one of the things that we've seen is the people who hold themselves out as perma-bull experts on silver have started talking about the paper silver price. Well, the paper silver price has fallen below $20, but the real silver price isn't. And that's one of those things that we use to allow us to say, okay, I don't need to listen to that person. Because the concept of a paper silver price is a farcical construct. The price of physical silver is the same as the price of paper silver, with a premium or a discount attached to one or the other, depending on the explicit form and the location of each. Anyone who talks about the paper silver price as if it were somehow different from the physical price, you know, for example, you'll hear people say, well, the real physical price is $45. What they should be saying is, in my belief system, the physical price really should be or ought to be $45, but it's not. Because if you really, all they're doing is obfuscating. They're refusing to pay attention to the reality. And part of that is because they don't have a clue, or they refuse to pretend, or they continue to pretend that they don't have a clue about what the paper market and futures and forwards and options are. They really don't know. And I was just watching over the weekend some of these guys talking about this stuff. Boy, they really don't know what they're talking about. And they're refusing to pay attention to the reality. If you have physical silver and you want to sell it today, the price you're going to get in reality is based on the silver price in the market, physical or paper. Anyone who agrees to pay you a real price of $45 is not an economic participant. And they're probably in some states vulnerable to having someone come along and say, sir, you're mentally incompetent to manage your own finances, and we're going to appoint a state appointed administrator. Now, the reality is that there's no such thing as a paper silver price as different from the real silver price or the physical silver price. They're all related. They're discounts and premiums, but it's there. And anybody who talks about the paper silver price is just obfuscating. And, you know, related to that, some of these commentators really need to train themselves. And I did find one this week, and it was very interesting because he did use the word I think he should use. A lot of them keep talking about, well, I think the silver price is going to rise, and I think there's this, and I think that's there. They should be saying, I believe because they're running on faith, not fact. Little editorial there. Our Platinum Group Medals Yearbook, we have rescheduled it. It was originally due to be released on the 28th of June, but with the Prospectors and Developers Association of Canada moving its conference from early March to mid-June, and with a number of other projects that we're working on, we have rolled the Platinum Group Medals Yearbook to July 26th. It will come out on July 26th. We will have an online briefing and webinar on that day. So stay tuned. We're into July. We're, as I said to my wife over breakfast this morning, we're on the downhill slope to Christmas at this point, having crossed the mid-year threshold last Friday. So we will be doing it. It will be July 26th, and we will be sending out notices and invitations to participate. You can always go to our website, get a lot of free reads. There's a lot of stuff about hedging, as well as other things. There's a whole section about good data versus bad data in our market views section. There's a whole section about silver conspiracy theories and why they don't have any basis for support in reality, the evidence against the silver conspiracy theories, the evidence that silver conspiracies do not exist, and some background about the people who promote these things too, which is very important. You really ought to know the background of the people that you vote for in government and listen to when it comes to investment advice. That's all I have for now. I'll talk to you probably at the end of the week. Take care. Take care of yourself. Take care of others around you. Take care of the world.